Hi, and welcome to the Options Newbie investment channel. So, what I've decided to do is make some videos for covering just basic options. So, for those of you who don't know what options are, or maybe you just started trading options, I'm going to make some tutorial videos just to kind of give you the basics on there. It's just purely for educational purposes. So what this channel is not, I don't give advice, for stocks, options, anything like that. So any examples that I use, of course, will be purely for educational purposes, like I say on here. Okay, so let's get started on here. And give me 1 second here. Got my little PowerPoint up here. All right. So what is an option? So again, it's, an option is a contract between a buyer and seller that gives the purchaser of the option the right to buy or sell a particular asset at a later date at an agreed upon price. So, so if you're buying a call option, right, that's giving the investor the right but not the obligation to buy the stock within a specific time frame. So if you're bullish on a stock, you think the stock is going to go up, and you're buying a call, then that would be the type of option you would want to buy for that. So put option works the opposite way. It gives the buyer the right, but not the obligation to sell a stock. So if you don't like the stock, you think it's going to go down, that's where you would buy the put. So the right, but not the obligation. Let me just explain that. You can exercise your option, or you can just sell the option at a profit if it's up on there. You don't have the obligation to buy it, like I say, because you have that choice to to either exercise it or or just sell it outright. I'm going to concentrate just on we call American style options. Basically, what an American style option is you can sell it at any time up until expiration. We're not going to cover European style options. Don't even worry about that. So buying a call option. I'll give an example here. And I pulled this example off of, based on, I pulled the example from Apple. And it's based on the price as of September the 29th. So one call option essentially equals 100 shares, right? So with that, you have to have a strike price, expiration date. So the example is Apple, which closed at $154.12 as of the 29th of September 2017. So let's say you're looking to purchase an October 20th. So that's the expiration date. Call strike of 155, right? So that's the price you think that the stock is going to go to, right? And then so the premium that you would pay for that, and again these prices are based off of the closing price of the day, is $2.22. So obviously you have to take that $2.22 times that by 100 because an option contract is 100 shares. So you would pay a premium of $222 for the right to purchase Apple shares at $155. So why would you do that? Well, maybe you think Apple is going to have a great product, great earnings. You basically you want to bet that you're betting on it is going to be beyond 155. Now, because you pay $222 for the premium, your break even on this investment is going to be $157.22. So it has to get beyond $155.22 for you to make any money on there. So obviously, if it's going to go up to $160.22, say by October the 20th, then you're going to make $300 on that, right? So let me just that's my example for that. Let me give you a just sort of a visual. Now, this isn't specific to the example, but this is a long call chart. So you can see, again, say you had a strike price of at 40, and maybe you think it's going to go to $43. You bet $200. That's your premium paid. So anything below, right? Anything below $40 here, you're going to lose the premium. That's 100% of what you paid on that. All right. So obviously anything, so this is $50, right? So then you're going to make, if we're assuming the strike is $43, you're going to make, $700 essentially if you're buying one contract on there, so on and so forth. Okay. So let's look at the other side of the trade here. So if you're buying a put option, so again, same thing, put option equals 100 shares. Same thing, you have to have a strike price expiration date. So, but with a put option, of course, you're betting on the stock going down. So again, in this case, Apple at $154.12. You buy the October 20th put with a strike price of $150.50. You pay $1.86, so again, $186 for the premium paid. So your break-even point is $150.64. So again, it has to go beyond that 150.64. So, below that, in order for you to start making money on that option. Puts just work the opposite way. And again, we're just concentrating on just buying calls and puts. You can sell them, but that's in another video that we'll get to. So for now, like I said, we're just concentrating on just buying long options on here. So a chart on this put looks a little bit different. Again, it's not specific to the example, but you got a $40 strike on here. Anything below, below 43, again, you're making money. Anything at 40 and above, again, you've lost your premium. In this case, $200 on this one. Okay, so risk and reward of buying an option. So obviously, you buy a call or put, your risk is the premium paid. That's all you can lose. You can't lose more than that when you're purchasing an option. Okay, and so you lose 100%. Your option will expire worthless. So OTM, or out of the money. Okay, so reward for call option is theoretically unlimited. There is no limit to how high a stock can go. Now, of course, it's unlikely it's going to go up, 1,000%, whatever. I mean, that's obviously highly unlikely. But there is no potential limit to how high that stock can go within that expiration time. Reward to a put, of course, is limited because the stock cannot go below zero. So your stock goes to zero, great, you make money in your put, but you can't make anything more than the stock going. Like I say, it cannot go below zero. So it's not unlimited in that case. So a few things to keep in mind. Out of the money options that are closer to expiration will lose time value quicker. So if a stock is it's going to lose that value especially if it's not in the money, right? So it's a lot. If you buy a $155 Apple call and it's at $150 and there's a week left for that expiration, well, it's getting less and less likely that it's going to finish above that. So that time value is quickly depleting, and the price of that option will quickly deplete as well. All right. So stocks that have earnings reports at the time of expiration tend to have a higher premium built in. So the stock that's reporting earnings around the time of their expiration on a particular option, of course, is going to be more volatile, and that premium is going to get built in to the price of that option. So again, same thing. Stocks that have higher volatility will also have higher premiums built in to in the option pricing. And let me give you an example of this. So I'm just going to go to Yahoo Finance here. So if we look at two similarly priced stocks, so we have Coca-Cola at $45.01 and Juno Therapeutics. So Coke, obviously blue chip, Dow Jones company, very stable. Juno Therapeutics is like a biotech. So there's going to be a lot more volatility in that. So let me just pull out the option chart here and look at the October 20th. So what's Juno at? 40. So let's look at the 45 calls. All right. So the price, and I'm just going to look at the last price. The price of the 45 calls for Juno, October 20th, $2.45. So okay, great. So let's look at Coke. Okay. So look at the 45 calls. Oh, wrong strike here. Let me look at October 20th, just so we're even here. Sorry about that. Okay, 45 calls for October 20th. 44 cents. That's a $2 difference. And the only reason for that, like I say, is Juno is far more volatile than Coke. I mean, if you look at the day range, pardon me, sorry. If you look at the day range on here, so for Juno, okay, days range, 43.96 is the low, 45.20 is the high, right? And then Coke, again, day range, 44.79 by 45.11, much tighter range. So yeah, that's where you're going to see that volatility priced in to those stocks. That's why you see such a difference on there. Okay, so let me go to the next slide here. So what happens at expiration? So in the money calls and puts will be exercised if you still own them, meaning that you will take. So if you get to the time of expiration, you still own the call. It is going to exercise your call. So if you have Apple, it's going to, at 155 strike, it's going to buy 100 shares at $155. Conversely, the same thing with a put, right? It's going to sell those shares of Apple at 152.50 or whatever it is, that your put strike price is. So if you have no intention of exercising the option and it's in the money, just sell it, right? Sell the option. You'll get the profit on selling the option, right? If it's a $155 call and the stock's at 160, well, if it's right at the time of expiration, say it's 10 minutes before the market closes, there's going to be that value, that $5 share value built into that call option. Same thing with a put. So if you don't want to exercise it, just sell it. You don't want to get up Monday morning and all of a sudden have your either be sold out, by the margin department, or not have the money in your account, and all of a sudden, 100 shares of Apple at $155 is a lot of money if you only have a couple thousand bucks in your account or something. All right. So in the out of the money calls and puts, they just simply expire worthless. You don't need to do anything on that, right? Unless it's close. If it's near like the at the money, you might want to do something. But if it's a $155 call and the stock's $150 at expiration, it just expires worthless. It'll disappear from your account on there. Okay. So advantages of options: obviously there's leverage. Small amounts of capital control. A large amount of shares. It's a lot cheaper to pay $200 for the right to purchase Apple at 155 than it is to buy the 100 shares at $155. So obviously there's significant profit potential, and they can also be used as a hedge. Again, we'll get into hedging in a later video. We're not going to concentrate so much on it now, but it can be used as a hedge on there. Okay. So disadvantages: obviously, options are highly speculative because you're betting on a direction, right? No one knows where a stock is going to be a month from now, 2 months from now, right? You can take an educated guess as to where you think it will be, but ultimately you are taking a gamble on that. So with that, of course, you can lose 100% of your premium, right? You can lose even more if you're selling naked options. Again, those has to do with selling options. We'll cover that at a later point. And wider spreads for options can increase your costs, as well as commissions are more expensive. So, usually when you purchase a stock that trades a lot, you might have like a cent or two between the bid and the ask, right? Options, you can see 5 cents, 10 cents, of that spread. So those wider spreads, if you're doing like a market order, then of course you're going to pay at the asking price. You can really get burnt on some pricing on there. You might want to always, I would say, use a limit order when you're purchasing options. I wouldn't use market orders because of those wide spreads. And commissions are going to be a bit more expensive as well, because you're going to have your base commission. So say it's $10 or whatever it is. Plus you're going to have a per contract fee. So, some you're going to have, maybe it's 75 cents or a dollar or whatever. So if you're buying, 10 contracts, right, you have that per contract fee of a dollar, let's say. So that's an extra $10 on top of your commission that you're going to pay. So commissions are certainly more expensive for options on there. But all in all, like I say, it's options are another way to play the market if you don't want to put out a whole lot of capital for that. So anyways, that's going to conclude this video on here. If you like the video, give me a thumbs up. Please let me know in the comments what you would like to see on the videos on here. So I'll be certainly happy to add it, or anything else that you want to cover on there. Please let me know, and I will make some more videos. I'm going to get into things like covered calls, cash covered puts, things like that. And in a second video, we'll talk about selling options, and we'll kind of work our way up to maybe some more intermediate stuff on there. But anyways, that's it for now. Tell me what you think, and we'll talk to you again later. Thank you. Bye for now.